Okay, and then let's just go ahead and open up the PDF for chapter 6 in full view. And let's go ahead and take a look and get some sense of point value here from the outline. Sars Engagements, okay, statements on standards for accounting and review services. And that's really what's covered in this chapter to a large extent, okay? And so these Sars engagements, you're going to see covered here in these various types of things that are done, although reviews, interim reviews are actually done under the SASs for non-public companies and PCAOB for public companies, okay? But these preparation engagements are done under the SARS, the compilation engagements are done under the SARS, and the review reports are done under the SARS. All of that is going to be about 10 points, okay? And then when we get to these interim reviews, that's all included in there. So you can expect a good solid 10 points. So that means multiple choice questions covering these types of engagements. That means potential task-based simulation covering the subjects here of these types of engagements, okay? When we get to letters for underwriters, we might have time to do that tonight. If not, you'll see it in the recording. That's about 3 points, okay? And then the AICPA Code of Professional Conduct, ethical requirements covered under the GAO requirements, SEC, PCAOB, Department of Labor. You know, they really start getting very, very granular in these codes of professional conduct, et cetera. So when you get to these areas, you'll even see on the recording, I tell you, I don't have a recording for those. What I want you to do is go through your pre-made flashcards, the ones that came with your purchase of the Becker material. Go through those flashcards and then work the multiple choice questions. To the extent that you can't find a flashcard that helps you with a particular multiple choice question, add a flashcard in there. Figure out a flashcard that would help you remember what was covered in that particular problematic multiple choice question that you had. And then you've got a good set of cards that are around these very, very light area. And then, of course, prior to your exam, review those flashcards so that when you get the 1-2 questions that might cover this area, you don't miss all those questions. You got a shot at getting some of those right. That's the best use of your time for those, because you can see you know, Becker goes on into some 20-some pages of material here. Meanwhile, we're talking about a one-off question. Not a good use of your time to read through the book, to watch one of the national lectures, blah, blah, about that stuff and come to no reasonable point or testing strategy for you on it. The best thing for you to do is just sit there and look at the flashcards that came with your package to see what is discussed in those flashcards, then answer the questions. If you do well on those questions, you get 80-90% on those questions based on the flashcards, fine. If you're having some trouble with that and you want to add a few cards that'll help you with questions that are maybe giving you problems, add those cards. That's all you need to do for those last few modules that they've put there. Okay. Question? Okay, good. So let's go ahead then and let's start to talk about SARS engagement, statements for standards on accounting and review services. So what happens? Well, there's a situation that we've been talking about is, look, we have the historical financial statements, and the auditor looks at those historical financial statements, and the highest level of service we provide is an audit. And so we've been talking about the way to audit the historical financial statements. When we got into a little bit of chapter 5 part, we said, okay, What happens if we do an engagement that looks at something beyond the historical financial statements? For example, forward-looking prospective statements. Well, now we're coming back to the historical statements, but what we're going to be doing here is providing a level of service that is less than an audit. So we're going to talk primarily, the big three, if you will, are going to be preparation of the financial statements, in which we provide no assurance. We don't write a report, nothing. We just prepare the statements and we walk away, and we let the client use the financial statements for whatever they need to. We could do a compilation engagement. In a compilation engagement, we're going to provide no assurance, but we're going to have to issue a report. And then we'll talk about a review. And with review, we provide something called negative assurance. That assurance is much more limited than what we give in an audit, which is a positive assurance engagement. Okay, so that's where we're going here. And you can see those type of engagements listed here that I just sort of rattled off: preparation, compilation, and review. Okay, now what happens with the preparation? And with the preparation, there is no assurance. We give no assurance of any kind, and there is no report. So really, the users of financial statements that we prepare probably wouldn't even know that the CPA was involved in helping to prepare those financial statements. So the objective of the preparation is to prepare those financial statements in accordance with the applicable framework, probably US GAAP. We do not provide any procedures on those. Okay, so we do not audit, we do not review. A preparation, as I wrote up there, provides absolutely no guidance, and it is considered a non-attest engagement. And what that means, if it's a non-attest engagement, it does not require determination of whether the accountant is independent. We don't have to be independent. We don't even need to do any sort of investigation to see if we are independent. Now, the reason it is considered a non-attest engagement is because there's no report. No report, it's considered a non-attest engagement. Non-attest engagement, you don't even have to determine if you are independent. You don't have to do anything to check for your independence. Now, with a compilation, the objective is to present in the form of financial statements information that is a representation of management without undertaking to express any assurance on the financial statements. So no assurance. So since there's no assurance, we do no audit, no review procedures, okay? And then we say that a compilation does not provide assurance because the report does not provide assurance, but a report is required, therefore it is an attest engagement. So with a compilation, no assurance, but we do prepare a report. And since there's a report, it is considered to be an attest engagement. Okay, now flashcard this last part. Although independence is not required, a determination of an accountant's independence of the entity is required. So we need to check to determine if we are independent. And if we're not independent, can we still do the engagement? That's a question.
Yes.
Yes, we can. Good. We can still do the engagement, and we have to, even though we're not independent, so we obviously they'll have to look to see if we are independent. Okay. With a review now, we give something called negative assurance. Negative assurance is an assurance in which the CPA, the accountant, you don't even have to be a CPA to give you do to give a review. The other two, the compilation, the preparation, you don't have to be licensed. To do a review, since you're giving assurance, you do have to be licensed, okay, by one of the states. And the assurance that you give is negative. In other words, what you will say is, I am not aware of material modifications that need to be made in order for the financial statements to be in accordance with the applicable framework, probably US GAAP. Now, that level of assurance is much more limited than the level of assurance that we give in a positive assurance engagement is which an audit is. So in an audit, we say, in our opinion, the financial statements are fairly presented. In a negative assurance and a review, we say we're not aware of material modifications. So a way to look at this is, for a negative assurance, the CPA is telling you what they don't know. With a positive assurance in an audit, we tell you what we think about something. We give our opinion, our thought, our conclusion about the financial statements. Much higher level of assurance than a negative assurance. Now, they call it limited assurance, and I personally find that a little annoying that the standards call it limited assurance, because when it's a negative assurance, because all assurance are limited. What is the limit on the positive assurance that we give?
Reasonable.
Excellent. We give reasonable assurance. Very good. So we don't sit there and say, kill us if we get it wrong. We say, hey, it was reasonable assurance. There's always a chance that we could be wrong. Okay. Okay, good. So what happens? A CPA may express a limited negative assurance on financial statements that have not been audited. Notice, guys, we always call out the higher level of service when we're talking about a preparation. We haven't audited, we haven't reviewed. When we're talking about a compilation, we haven't audited, we haven't reviewed. When we're talking about a review, we say we haven't audited the financial statements. Okay. However, we will generate a report. It's going to be a review report. So the objective of the review engagement is to express limited assurance that there are no material modifications that need to be made, nor for the financial statements to be in accordance with the applicable framework, probably US GAAP. Now let's see what they tell us here. A review is based on inquiring analytical procedure performed by CPA. The part I want you to flashcard here, a review is both an insurance engagement and an attest engagement, because we are attesting. Even though we are testifying, I'm not aware it is a negative assurance, less than the attest that we give in a positive assurance audit, and independence therefore is required. Flashcard that. Okay, question. Now, I've mentioned this before, but it is possible that you will walk into a client. I had an engagement a long time ago where I asked to see their general ledger, and they handed me an Excel spreadsheet with accounts going across the top and then totals of what was in those various accounts going across the bottom. No double entry bookkeeping. So I'm like, how am I going to audit this? So what I did was I took their Excel spreadsheets, and it was basically a cash receipts, cash disbursements journal, essentially. And for the various transactions I saw listed in there, I went ahead and did a journal entry in a general ledger software. So I took off on the train. I was in Washington, D.C., took off on the train. And by the time I hit New York City, I had a general ledger that I prepared using this general ledger software, so I could then go back on Monday and start my audit. So I turned it into a little trip, plus doing some work on the train on the way up and to New York. And in that case, I did a preparation. But since I then went further beyond just looking at their cash disbursements, cash receipts journal, putting things into a general ledger format, I went further and then confirmed accounts receivable. I went and confirmed with the bank statements. I did, check for unrecorded liabilities, all those things you do in an audit. So the report that we issued in that engagement was an audit report, even though we also did a preparation. So you can provide more than one level of service when you're doing an engagement, and you provide a report for the highest level of service that you provided, even though I also did a preparation. The reason I did the preparation is I'm like, there's no way I'm going to be able to pull a set of financial statements from this. Well, the reason I put it in the general ledger software, you can't audit a cash disbursements, cash receipts journal. You got to have a set of financials that you're working from. So I just went ahead and did that. Okay. Question.
So if you prepared, if you prepared and did an audit, doesn't that mess with the independence?
No, because I went beyond the steps of just if I prepared the statements and then issued the opinion, yes, but I didn't stop there. I prepared the statements essentially, and then I went and said, okay, now I need confirmation of your bank accounts. Now I need information on your client list so I can reach out and see to what extent the confirmation confirms some of the transactions that they recorded for revenue, et cetera. I mean, we did a variety of procedures, including at the end of the engagement, I got a management representation letter. And in the management representation letter, they turned around and they signed that they were responsible for the financial statements. So if management takes responsibility for the financial statements, then you're able to go ahead and do the preparation. Of course, you would have all of that and the audit. Of course, you would have all of that in the engagement letter to begin with, that you're going to do this and then you're going to go this step further and they accept responsibility for the financial statements. There's a contract to that, then you can provide a more than one service in an engagement. But your audit report has to cover the highest level of service you provided.
Okay. I was thinking that it was uncommon for like a firm to do a preparation and then go ahead and audit those financial statements, but yeah.
You obviously have never audited the House of Representatives Child Care Center in which the book is a nurse. Try it sometime.
I haven't audited anything.
Okay.
I don't plan on trying it anytime soon either.
Yeah, I mean, you have to be careful. I'm not saying that you can just be careless and start slapping people around and say, hey, here's your financial statements. They have to accept responsibility for them. But if an entity needs an audit, what are you going to do? They need to have the audit. They don't have the staffing and the wherewithal to prepare a set of statements. Okay, well, we have a solution to that. The C prepares and then goes further and also gets cooperating independent third party information, et cetera, to allow you to perform whatever other service you want by preparation. If it's simply a compilation, an audit, or it could be a review. If it's a compilation, the only difference is now you're issuing a report. Okay, but independence is required. I can't do that work. So the preparation doesn't destroy the independence. It's just that you don't have to be independent to do it. But if you start going further down that path to give a negative assurance or a positive assurance in an audit, then you have to do some work that is commensurate to that level. Okay. Okay, good. Let's go ahead then, and we're gonna take a look now down here at the professional standards. Okay, and by the way, a firm may have some internal policy that doesn't allow them to do that kind of an engagement. And if that's the case, that's a firm policy. So you may, in your respective firm, maybe they don't do that. If that's the case, that's a firm policy. That is not something that's in standard. In my office, in the GAO, it was written into legislation that we will audit this entity. We have to audit it. All I did was give myself a set of financial statements to audit because they didn't have financials. All they had was receipts and disbursements. Okay, all right, let's go ahead and let's take a look at the statements on standards for accounting and review services. They are issued by the Accounting Review Services Committee, again, of our buddies, the American Institute of Certified Public Accountants. Okay, and they cover the type of engagements that we were just talking about. And the question becomes, well, if you compile, review, prepare a set of statements that you're not going to be auditing, you will follow those standards. Now, the question becomes, What if I breathe on a set of financial statements? What if I hold a set of financial statements? Am I now bound by these standards? And they do have some engagements in which the accountant can be involved and not have to follow the SARS. Okay, for example, SARS do not apply when we are doing some other type of work, such as preparing tax returns, etc. Okay, if we are just providing a automated bookkeeping services, okay, all of these things the SARS do not apply. Okay, now if we prepare many adjusting entries, that could be considered a preparation, and then the SARS would apply. So if you just make a few journal entries, a few adjusting entries, consult on financial matters, etc. Let's say you suggest a software that they might want to start using. Let's say I went to that entity and said, hey, you might want to start using this Pacioli software, whatever, that allow you to prepare the statements, and I trained them on it. As long as I wasn't getting any money from Pacioli to recommend that, it would be fine for me to go ahead and do that kind of work, and the SARS would not necessarily apply in that situation. Okay, coming down, review of interim statements, and as I've already mentioned, when we do reviews, we're going to follow, and if it's a non-public company, we'll follow SAS, that's for non-public. If it's a public company, they put us back under the PCAOB standards for public company. And the reason when we do an interim review, we're doing a review of, say, quarterly statements. And companies typically don't prepare quarterly statements unless they're building up to what? A set of year-end financial statements, and those year-end financial statements will be audited. So what they do is they pull the review of interim statements back under the auditing standards, because they sit there and say, well, since you're going to eventually audit those anyway, we're going to pull those back under the auditing standards. Okay, so the SARS don't always apply just because the CPA looked at financial statements, but you start going more and more involved, then you start heading towards the path of preparation, then the SARS start applying. Okay. Okay, good. Come over, and you can go past a lot of this stuff here. They just keep going on and on about different things. Some of these we'll cover later. I just want you to go ahead and take a look at our first multiple choice question now. Then we're going to start to dig in to the specifics of these different engagements. Okay, guys, let's make sure we're clear on what the objective of this class is, which is to do the best you can to use the information that we've talked about to answer CPA exam questions here in class, and then moving forward towards your exam. Am I correct that that's the objective? Okay, so
Correct.
what I want to do is go back. SARS do not apply. Okay, let me go ahead and take that poll down for a second. Okay, and let's take a look. SARS do not apply to other accounting services provided as of accounts, such as preparing one or a few adjusting or correcting entries, consulting on financial matters, preparing tax returns, rendering manual or automated bookkeeping services, and processing financial data for clients, blah, blah. Okay. Note that if the accountant prepares many adjusting or correcting entries, this could be considered a preparation of financial statements, and the SARS would apply. The accountant must exercise judgment in making this determination. Okay, so now when I put that question back, an accountant is most likely going to be required to follow statements on standards for accounting and review services, SARS, when the accountant has typed client prepared financial statements without modification as an accommodation to the client. Very limited involvement. We're just typing statements that who prepared it?
The client.
Client prepared. All we're doing is typing for them. B, provide a client with a financial statement format that does not include dollar amounts to be used by the client. Who prepared the financial statements?
The client.
The client. C, propose correcting journal entries to be recorded by the client that change. Who prepared the financial statement? Client prepared statements. D, use information in a general ledger to prepare financial statements outside of an accounting software system. I don't know what that means, outside of an accounting software system, whatever. It's what? Now we are preparing the financial statements, aren't we?
Yes.
So the SARS apply?
Yes.
Okay. All right, guys, stay visual in how you're going through these questions. Don't get sloppy. Okay. All right, good. Let's go ahead and let's take a look at now preparation engagements. Okay. Remember, with the preparation engagement, there'll be no report, no assurance. Though we were never involved in the preparation in any way with those financial statements. Okay, so let's just go ahead and let's take a look at something important. For all engagements, we have said the same thing for an audit. We're going to say the same thing for preparation, review. What? Okay, let's go ahead and mute so we don't get a lot of ambient noise. Okay. Okay, good. So what happens in engagement, any engagement, preparation, compilation, review, we know already for an audit because we talked about it back in chapter 2, I think, we must have an engagement letter. Always have a written engagement letter. Always. All the engagements, you got to have a written engagement letter. Okay. Now, what you're going to see here, it's going to sound familiar to you, particularly if you've already started to review for your exam, looking back at chapter 2 when we talked about the contents of the engagement letter and an audit, because it's very, very similar here. We're going to say, hey, what is the objective of the engagement? We talked about that in an audit engagement letter. What is management's responsibility? Okay. Now, this part of the engagement letter for a preparation is going to be different because of the very different purpose objective of a preparation versus an audit. So there has to be an agreement from management that each page of the financial statements will include a statement indicating that no assurance is provided on the financial statements, or the account will be required to issue a disclaimer that makes it clear that no assurance is provided on the statements. In other words, you're going to start generating report. Now you're heading towards a compilation if they don't put on each page of the financial statements no assurance. Okay, so each page of the financial statements needs to say no assurance. Flashcard that, because that's unique to a preparation versus what we see in an engagement letter, say for an audit or the other engagements. If they don't do that, then you'll have to essentially issue what is equivalent to a compilation report disclaiming an opinion on those, that is disclaiming any assurance on those financial statements. Okay. Okay, good. And then, as we said, for an audit, you need to have the accountant responsibilities in there. Notice we don't call it auditor responsibilities because we're not auditing. And then what are the limitations of the engagement? Okay. Okay, good. Now you come over, and in the engagement letter, we will have to identify the applicable framework, and then whether the financial statements are known to contain a departure from the applicable framework. If they are, then the expectation is that management would tell us that up front. Okay, so you start to take a look. Why don't you go ahead and flashcard everything in the engagement letter, but make sure you definitely have that. That's very unique to a preparation engagement letter, and know that you have to have one. Okay. Okay, good. Now they give us an example of the engagement letter, and I don't know why Becker goes on and on to provide examples of all these engagement letters and letters all the time. They take up a bunch of paper. However, notice that there will be a statement that there will not be a report because there is no report. Okay, so we make sure in a preparation, so we make sure that that is called out in the preparation engagement letter. Okay. Okay, good. Now let's go ahead and see what some of the requirements are in order for us to prepare the financial statements. And let's just take a look here. And they tell us the accountant should ensure that a statement has been included on each page of the financial statements, that no assurance is provided. So it's in the what? It's in the engagement letter, and it is an objective of the engagement. Okay, no assurance is to be provided on these financial statements, and so we will have to say we have to note that there has been no assurance provided. So we haven't audited, we're not reviewing, we're not compiling, and no assurance is provided on the statements. Typically what we're going to see is when we write the report, there's no report in this case, but when we write the reports, we often call out the higher level of services. So the standard is just telling you here, if you're doing a preparation, you're not doing these other engagement. Okay. Now, if the accountant is unable to include a statement on each page of the financial statements that no assurance is being provided, you'll have to issue a disclaimer to those financial statements that there's any assurance, or move to a compilation engagement in which you'll say that in the compilation report. So you notice the big deal here is just making sure that everybody understands that what? There is no assurance that's being given, and that should really be put on every page of the financial statements, and we're really going to make sure that they do that. Okay, but if you have to issue a disclaimer because they won't do that for some weird reason, there it is. That's what it would look like. Okay, Now, if they prepare statements in accordance with a special purpose framework, cash basis, whatever, then, and they say the accountant should include a description of the financial reporting framework on the face of the financial statements or the notes of the financial statements, and I don't like the way that's written. The accountant should ensure that management make sure that that's on each page of the financial statements, or there's a footnote. So they're saying the accountant should include, because we, are preparing the statements, but we're just making sure that what each page has that statement on there. It's not, what I'm trying to say there is it's not written in the voice of the accountant. It doesn't say accountant says that, here's the applicable framework. It's something that's just included in the financial statements that are the responsibility of management. Okay. Now, when we do a preparation, okay, under any of the appropriate frameworks, a US GAAP, whatever, then if that's the situation and we discover information is incorrect, incomplete, we will want to obtain additional revised information from the client. So we're saying, hey, we're trying to prepare the statements and you don't have the information here that's going to allow me to prepare the statements, then we would ask them for that information. If we ask for that information and they refuse to give it to us, then the accountant should disclose a material misstatement or misstatements in the financial statement. So we'll first ask them to fix it. And if there's no information that allows us to fix it appropriately, they didn't keep the accounting records or something, then we're going to have to go ahead and disclose what that material misstatement is. Okay. Now, it is okay to prepare financial statements that omit all disclosures, but there are certain conditions to that. So they tell us the accountant may prepare these statements provided the accountant discloses the omission of the information, and this was not intended to mislead anybody, etc. And so you can flashcard that. Okay. Okay, good. So there'll be no report, but there's a lot of stuff stuck on the face of the financial statements that calls out misstatements, calls out certain disclosures that might be missing. So it's kind of like you're doing some of the things that we talked about for qualifications with explanatory paragraphs and whatnot. But instead of it being contained in a report, now it all starts getting slapped in the financial statements, either on the face or in the notes somewhere. Okay. Okay, good. Documentation in a preparation engagement. Documentation should include, okay, let's flashcard because it's a nice summary of what the major requirements are. The engagement letter, what were the financial statements, were there significant findings or issues, you found misstatement, how you handled that. You had a footnote in there to disclose what the misstatement was. It omitted disclosures. You put that in the statements, whatever. Okay, question. Okay, good. Let's move to compilation. And we're going to see that the big difference now between a compilation and a preparation is what? Still no assurance. So that's the same. But now what are we going to do? Now we're going to see a report. We're going to issue a report. That's the big difference. So do you have to have an engagement letter? Yes, have to have an engagement letter. Will the engagement letter talk about the objective of the engagement, management's responsibility, the accountant's responsibility, limitations of the engagement? Yes, just like it does in an engagement letter for an audit that we talked about at day 2, for a preparation that we just talked about. The big difference now for the compilation versus the preparation is, of course, the compilation engagement is going to say, hey, we're going to have a compilation report. It's going to talk about its form and content. Okay. Again, they go on and on with a letter that is wasting paper to a large extent, other than sitting here and what? Yeah, Now we're going to have a report, right? So just realize that you have to put in the engagement letter that there will be a report. Of course, in all engagements, okay, I didn't highlight it last time for the preparation. It's a sort of, common sense thing. You have to have client knowledge of the client's business, knowledge of their industry. Okay, don't worry about all this nonsense here with it. I don't even know what these bubbles mean. Okay, but just take a look here. The main step that you have to do in a compilation, because in a compilation, it could be that the entity prepares the financial statements. And so you're saying to me, well, why are they hiring an accountant for them? They're wasting money because somewhere they have a use for those financial statements in which they need a report from an accountant. And so they turn to you and they say, well, we need you to issue a report. Now you can't sit there and say, oh, okay, well, since I'm not giving any assurance on these financial statements, I'll tell you what, where I don't even have to be independent. So let's go out, let's take a couple shots and I'll issue the report to you. Okay, no, they're still going to require, the standards still require that you can't be, crazy. You crazy kids, you're going to have to at least read the financial statements looking for obvious errors. Okay, now what's an obvious error? Do you think you should issue a compilation report for an entity if the balance sheet doesn't balance?
Absolutely not.
No.
No. Okay. Do you think you should issue a compilation report if they sat there and they reported net income and then net income didn't get closed out properly with the statement of retained earnings? Okay, these are the kinds of things that they're talking about. You're going to read through, follow through, see that the statements are reasonable. You can't just go wild and say, well, I'm not giving any assurance, so who cares what's in there? This is the problem with being a CPA is what? There's always some level of professional responsibility that the profession has decided, hey, we're going to be accountable for this, right? Okay. So just go ahead though and flashcard that what? We have to read the financial statements, okay? And we are looking for what? Obvious material errors. And you say, well, what's an obvious material error? Well, I gave you a couple examples. The exam isn't going to ask you, is this an obvious material error? Because that's a matter of judgment, isn't it? So what they're going to say is there is an obvious material error, or what are you trying to do in a compilation? You're looking for obvious material errors, okay? So just go ahead and flashcard that, okay? Now, if the financial statements are inaccurate or incomplete, so when you do that read and you discover information is incorrect, incomplete, or unsatisfactory, then obtain revised information from the client. So if the balance sheet doesn't balance, you're going to say, make it balance. What's going on here? Okay. Now, what if the client says, hey, you're not giving any assurance, so don't tell me to make my balance sheet balance. Then if that's the case, we will what? We will withdraw from the engagement. Now, sometimes students say to me, well, John, why can't you just give a disclaimer? Or why can't you give a scope qualification or a gap qualification? Qualifying what? Disclaiming what? I'm not giving an opinion, so there's nothing to qualify. There's nothing to disclaim. And so if the client is refusing to correct an obvious error, I have no choice left but to do what? Withdraw from the engagement. Okay? Okay, good. Now you come over and let's see what the documentation is going to be. I'm not trying to strike that out. I'm going to ask you to highlight that and flashcard it, right? Because I'm in love with documentation sections here. And they're always a nice summary of what we're supposed to do. In this case, in a compilation, we need the engagement letter. We're going to have the financial statements, a copy of those in our documentation, in our work papers. We'll have a copy of our report. Okay. Okay, good. Now, since we're talking about the report, let's see what the report will look like. Okay. So the accountant's report and compilation engagement needs to be in writing, and let's flashcard some of the key things. Just flashcard the ones I highlight here, include a statement that management is still responsible for the financial statements. Okay, so even in a preparation, we don't have a report. Even in preparation, management is still responsible for the financial statements. We're just helping them to prepare them in the form of a set of financial statements, but they're still responsible. Include a statement that we performed, this is now the report, right? That we performed using the Sars, okay? And be careful with that the Sars are issued by the AICPA. Make sure you have that on the flashcard, because who writes your exam?
AICPA.
AICPA. And I feel like sometimes they get into like a who's your daddy thing. Who's the one that's supposed to, whose standards are you supposed to follow? AICPA. They like to make sure everybody knows, that they're in charge. Okay. So, make sure you remember that they're the ones that write the standards. Put that on the flashcard. Okay. Include a statement that the accountant did not audit or review the financial statements. So when we start issuing these reports, we like to call out the higher level of services. So it's a compilation report, so we say we didn't review. It's a review report, we'll say we didn't audit, and I'll show you that when we look at the reviews here in a couple seconds, okay? Nor did we perform any procedures to verify the accuracy, completeness of information, and we do not express an opinion. If we say that we do not express an opinion, what do we call that? Matthew?
I was going to go with the negative assurance, but
No.
not it.
There's no assurance at all. And so if we're not giving an opinion, we're disclaiming an opinion, right? Okay, good. Okay, I wasn't picking on you. I mean, I was picking on you because I figured you would get it right. You disappoint me. No, I'm just kidding. Okay, so disclaim an opinion. Good. Okay, all right, good. I'm just joking. You don't disappoint me. It's okay. All right. I'm having trouble explaining why I asked you, and it's a good thing though. Okay, all right. Additional paragraphs are required when we are using a special purpose special purpose framework. Disclosures are omitted. The accountant is not independent. Now, we're not required to be independent, but if we're not independent, remember we have to check to see if we are, and if we're not, then we have to do what? Then we have to disclose that, okay? There are known departures from the applicable framework. So you're saying, well, how would we know if there's departures? Well, we read the financial statements for obvious errors. We asked them to fix it. They didn't refuse. They didn't tell us here. They said, we can't. We don't know how to properly account for this. We don't have the information. We can't make the balance sheet balance. Well, if that's the case, then we can still issue the compilation report, but now we have to do what? Now we have to disclose in the report that there are these problems. So even though we're not giving assurance, if we know there's problems, that darn license says, hey, you better go ahead and you're going to have to follow, be responsible, and tell the world about those known departures, okay? And if there's some supplementary information, we have to call that out, okay? So flashcard those requirements. Notice that each page of the financial statement still has to say, see the compilation report. Now it doesn't say no assurance given of any kind. Now it just says, hey, see the compilation report, because the compilation report is going to tell you what? There's no assurance, okay? And you do not have to issue the report on your letterhead, on the accountant's letterhead. Flashcard that. I could see that being a stupid kind of question that the exam would ask, which is like, who cares? But somebody who doesn't know how to write a good question might choose that as something that they submit. You know, these people that write the CPA exam questions, you know how they get involved in that, right? Every so often, the AICPA goes out and says, oh, who would like to be involved in writing CPA exam questions? And people volunteer to go ahead and do that. And I've met one person that did that before, and I wasn't impressed. Okay, so that's why you get weird questions sometimes, and they're trying to hurry up and get those questions in there. And every now and then someone comes up with a who cares question just because that's all their talent would allow them to come up with. Sometimes students will say, well, why don't you get involved in writing the questions? I can't, because one of the things you sign is that you're not involved in any way preparing students for the CPA exam, and I would not be able to attest to that. Okay, so you come over and they show us the report looks like. Okay, we don't need to go through detail there because we flashcarded the key elements. Okay, coming over, and if we are using a special purpose framework, cash, whatever, then that's the case. We are going to have to indicate that the statements are going to be prepared in that applicable framework and refer them to a footnote. Okay, so if they follow cash basis, then we'd have to say, hey, this is a different basis other than GAAP, and you know, see the footnote that describes the basis that's being used, cash, whatever. Okay, all right, good. Now you come over, and we said this before when we were talking about preparing statements under regulatory or contractual basis. Those statements are almost always what? Almost always restricted, and we refer them to the appropriate note. Well, I don't see how this bullet versus this bullet are any different, okay? I mean, it's the same point. We're following something other than GAAP, such as a regulatory. But the statements are often, I thought they put it there. It's such an obvious thing that you'd think they would put that there. And I thought, I guess my mind put it in there, even though it's not there. Those statements are often restricted. Okay, when you have statements that are following a regulatory contractual, remember we said that those are restricted unless it's being prepared under a regulatory basis and the financial statements are available for general use, then that's obviously not restricted. But for the most part, when you see regulatory or contractual requirements, those statements will be restricted, and that's the case even if you're auditing those statements. Okay, now if statements omit substantially all disclosures, okay, it is okay to compile those statements because sometimes their use is going to be very basic and they don't need the litany of GAAP disclosures with those statements. And so you're just maybe going to prepare the balance sheet, income statement, statement of retained earnings, and a statement of cash flows, and that's it. And maybe one footnote that gives the summary of significant accounting policies, whatever. Okay, well, it's okay to compile those statements. However, you're going to have to add an additional paragraph to your report that's going to call out that they are omitting substantially all disclosures. And that's okay as long as, you know, they're not doing that to deceive anybody. So flashcard that it's okay to compile statements, and then just make sure that you know here that you'll have to put that in a note, the omission of one or more notes. You'll have to put that in your report that they've departed from, they've left out most of the disclosures. And you can see that right there. Okay, what that would look like. Okay, good. Come over, and it's also here. Why don't you flashcard it here rather than up there? So it's the same point. You don't have to flashcard it here. I showed you here, but since they went ahead and gave us a pass key on it down here, I guess, is that what this is? They call it a pass key. Yeah. Finally, a pass key that's worth something, because this gives us the basic that it's okay to compile the statements as long as you meet these requirements. Okay, so you can see they give you the sample report when they omit the disclosures. And again, if we find a departure, now how do we find the departure? Reread the financial statements for obvious departures. And if there's a departure, Then what? Then we will issue a separate paragraph, which will include disclosure of the effects of the departure if known. If the accountant believes that disclosure of the report would not be adequate to indicate the deficiency in the financial statements, you need to do what? You need to withdraw from the engagement. So again, what are we doing? We're reading the financial statements for obvious errors. We find them. We say, management, will you fix this? Management says, here, no, we're not going to fix it. We refuse. Okay, then we're withdrawing because there is no qualification. There is no disclaimer. We read the financial statements for obvious errors, or maybe when we walk in, they tell us, hey, we got a problem. We can't figure it out. What do? We disclose it in our report so that everybody knows that there's this obvious error here that they can't seem to come to. At least they didn't tell us to refuse to try, but they just can't force them to come up with the answer for something that they don't have. So we disclose in the report that there's this departure from the applicable framework, probably US GAAP. If we describe the effects on the financial statements. What this blue is telling you here, if the problem is such that you can't even really get a good feel for what the effect is on the financial statements, how it could maybe change the user's ability to even use the financial statements, then you have no choice but do what? To withdraw from that engagement, because there is no disclaimer, there is no qualified, you have to withdraw. Okay? Okay. By the way, we don't call this a modified report. Put in there, note. This is not called a modified report. And the reason I'm telling you that is I've seen standard questions where they sit there and say, the auditor should issue a modified report, and they're being kind of mean there because you are modifying the basic report, but we don't call it a modified report. We save the term modified report for where we're giving the assurances on the report. If you're not giving an assurance, you don't call it a modified report. So it's kind of a technical, annoying point that I have seen called out in some questions. Okay. Okay, good. So let's just come over, and obviously the big deal between a compilation and a review is that what? Basically the procedures are the same, but with a compilation we do what? We issue a report, whereas with the preparation we do not. Okay, good. Now, when you look at questions dealing with compilation, reviews, preparations, what they like to do is they'll call out the engagement and they'll say, which of the following would the auditor do, would the accountant do? And then they have 3 wrong choices that call out procedures that you would do in one of the other engagements. So if they're talking about a compilation, they might call out an audit procedure, they might call out a review procedure. If they're talking about a review, they might call out an audit procedure. Okay, so that's the way to look at these questions. Okay, under which of the engagement would I do the procedures? It's tricky because all the procedures listed are probably good for one of the engagements. Your job is to select the right answer in which they're calling out a solution, a procedure that is specific to the type of engagement that they're mentioning. Okay. All right. So keeping that strategy in mind, let's go ahead and let's take a look at this first one here. Okay, guys, let's go ahead and wrap up this one. Almost everybody except one person's had a chance to look at this. Okay, good. So let's go ahead and take a look at the results, and excellent. Okay, we've got most folks choosing A. Okay, now that says 83% of us. That's great. But let's go ahead and let's look at this question. Now, they're telling us that we are doing what? We're preparing a compilation, and they ask us which procedure should we perform here, right? Okay, and they say read the financial statements to determine whether they're free of obvious mistakes. Yeah, that came right out of the outline, right? And that's the main procedure. Hey, does the balance sheet balance? Does net income roll into retained earnings, right? That kind of thing. Now you take a look at B, obtain written representations from management. We did not say that. We never said that we get written representation from management. We get an engagement letter, but we don't have a management rep letter. We haven't said that yet. We get it in an audit. We said it for an audit. We will see it for a review. We don't need a management rep letter in a compilation. We don't need it in a preparation. Okay, so no. C, making inquiries of management at the stakeholders board of directors meetings. First of all, I don't know that we are compiling statements for a public company here. And even more so, there were no discussion of inquiries. We simply read the financial statements for obvious errors. Applying analytical procedures, you would do that. We're required to do it in an audit, during the planning phase and the final review stage, not our Becker final review, but final review stage of the audit. We don't have to do that in a compilation. We don't need to do that in a preparation, even though they weren't asking us about prep here. For a review, we will see that one of the main things we'll be doing will be inquiries and analytical procedures, but they were asking me for a compilation here. So no, D is not correct. Okay. Okay, good. Let's go ahead and let's take a look at the next question. Okay, guys, let's go ahead and take our best shot at this one. Okay, and good. We're getting good results here that most of us are getting this right. 83% of us chose C. And let's just go ahead, though, and take a look at this particular question. Most of us got it right. Okay, so financial statements of a non-issuer compiled without audit or review. Okay, now we haven't audited, we haven't reviewed them, but we have what? We have compiled and what should be in the report. Okay. A, the scope of the accounts procedure has not been restricted in testing the financial. We didn't test anything. We're not providing any assurance. We're not doing any testing. All we do is read the financial statements for obvious errors. So no, we're not going to be saying that. The accountant evaluated the appropriateness of the accounting principles. No, we didn't. We simply read the financial statements for obvious errors. The accountant has not audited or reviewed, therefore we're disclaiming an opinion. That was something that was right on the flashcard. You say, we haven't audited, we haven't reviewed. So you always call out the higher level of service to say, we didn't do it. We didn't audit, we didn't review, okay? A compilation is primary includes analytical procedures. No, it doesn't. It simply involves reading the financial statements. So we're not going to put that in the report because we're not doing that. Okay. Okay, good. Let's go ahead and let's take a quick break, guys. By quick, I mean our regular 10 minutes, which is quick. Okay, so I'm looking, we'll be back. Let's just make it 6:35. Okay. I'm going to hit pause. Somebody please remind me to hit record when we come back, okay? Go ahead and resume the recording. And let's go ahead and pick up now with review engagement, okay? Now, remember with the review engagement, as we kind of move up the food chain here, now we're going to obviously issue a report. That report is going to contain assurance. It is not as high a level of service as an audit, because in an audit, we give the positive assurance in our opinion, the financial statements are fairly prepared. And instead, now we're just going to give a more limited assurance. That limited assurance is a negative assurance. Okay, so it's higher than the compilation, but not in the preparation, but not as high as the review, in that we give, not as high as the audit. This is a review, and that we give negative assurance. Okay, so in the negative assurance, we say that we are not aware of material modifications that are necessary in order for the financial statements to be in accordance with the applicable framework. So if we're giving now an assurance where with the compilation, we weren't giving any assurance, then we're going to have to do something more than just read the financial statements for obvious errors. And what we're going to do is provide inquiry and analytical procedures. So now some of those questions that we looked at where they're saying, hey, inquire, analytical procedure, and those were the wrong answer for compilation. If we saw those same procedures being called out in a review engagement, then yes, we would do those. Okay. Now, important, we are still, though, not auditing the financial statements. Therefore, we will not be required to obtain an understanding of the controls. We will not have to assess control risk, okay, because we're not in an audit. So all of that about obtaining an understanding, assessing the risk of material misstatement, that's for an audit. We don't do those things in a review, okay? Okay, now because we are giving assurance, then we have to be independent, okay? So for the preparation, for the compilation, we didn't have to be independent, and I already asked you to flashcard that in the introduction. For the review, we do, okay? Now, you come over, and they give us this these bubbles, and I'm going to fill these out just because it's cute. I don't think that it's terribly useful to us, okay? But it's cute because it's you liar CPA. It's calling out the things we need to do in a review. But the key ones that we're going to talk about are inquiries, analytical procedure, and we will get a client representation letter. So let's talk for 1 second about client representation letter. We don't have to get it in a preparation. We don't have to get it in a compilation. We do have to get the management representation letter in a review, and we've already learned we need it in an audit. Now, what we're going to see is the contents of the management representation letter and review is very similar to what we saw already for an audit. So it's not like we have to learn a bunch of new things that would go into a review management representation letter. We just have to realize that we do have to provide it. We're going to flashcard that here in a second. One more thing that's important here is that we do have to have the engagement letter. So all of the engagements, audits, reviews, compilations, preparation, you do have to get the engagement letter. Okay, so we know that now. And guys, I'm not asking you to flashcard these. I'm just doing this to show you. It's the same broken record for the engagement letter and all the different engagements. Management's responsibility, the objective engagement, the accountants, we don't say auditor's responsibility because we're not auditing, limitation of the engagement, identification of the applicable framework. And we don't see this in the preparation because there is no report, but for both compilation and review and of course audit, we talk about the nature of the reporting that we're going to do. So again, I don't know why they keep giving us these full letters here. And the only thing I'm interested in showing you here is, hey, yeah, we do have to issue a report. Okay. All right, good. Now we're going to make 2 flashcards coming up here. Okay. One you can see here is a not required. What's not required in a review? What are some things that are not required in a review? And then when we flip to the next pages, we're going to make a flashcard of the things that are required in a review, okay? Because the exam likes to trick us into calling out things that would be done in an audit that are not required in a review. For example, in an audit, you will understand the controls sufficient to evaluate the design and determine the controls have been implemented and make an assessment of the risk and material misstatement, right? Obtaining the understanding, making the assessment, potentially testing the controls. We don't do any of that in a review. We do not do any of that in a review, okay? We obviously don't perform audit tests because we are doing a review. And in a review, we do what? We rely on inquiry and analytical procedures. We do not have to assess fraud risk. Do we in an audit? Yes, we do. We spent quite a bit of time flashcarded the heck out of that when we were talking about the fraud standard back, what, chapter 2, whatever, okay? Communication with the predecessor accountant, don't have to do that. In an audit, you do. Remember, you were the predecessor, I was the successor, and there was a set of inquiries that I had to make to the successor, to the predecessor auditor. For example, what's the reason for the change of auditor, all that stuff. Forget all that when you're doing a review. You do not have to have that communication. Okay, so that's a not required flashcard. Now we're going to make another flashcard. Okay, and this flashcard is going to say what is required in a review. Oh, by the way, guys, you may have seen, before I forget, I put up some information about attending a meeting on just before our BEC class, which you don't have to come to on Wednesday, from 3 to 4:30. It's a membership meeting for an organization called Ascend. Some of you maybe heard of Ascend. It's a Pan-Asian business association. It really has a lean though towards accounting, okay? And it has a similar objective to what the Accounting and Tax Club has here at Golden Gate. it's a little bit different in that I believe that some of these organizations like Ascend, like NABA, like Alpha, NABA is the National Association of Black Accountants. Alpha is Association of Latino Professionals for America, but the F and the A used to stand for Finance and Accounting. So it is also a accounting focused type of entity. All of these organizations are a little different from the Beta Alpha size or the whatever they call the club here at Golden Gate, Chi Pi Alpha, whatever. And that all of these groups have professional chapters. And the professional chapters do a good job of supporting the student chapters at the university campuses. So Ascend reached out to me and asked if I would be willing to help them start a chapter here at Golden Gate. And I think that would be very good for our students. So I agreed to help them start that chapter here. And we are going to have a welcome night on Wednesday, this coming Wednesday from 3 to 4:30. And I provided some information for registering for that. I recommend you go to that, and no, you do not have to be of Pan-Asian descent, whatever. You know, there's no blood test to join the thing. It's open to all individuals. My goal at some point would be to also have a group with NABA and with Alpha. I'm a former president of the local Alpha professional chapter. And so I'm very supportive of all these groups. It's just that Ascend reached out to me. And so I think it would be good for everyone to come to that because you're going to be meeting right then with, for example, an individual from Oracle who is heavily involved. And they're going to have some folks come from one of the other firms, BPM is going to be there. So it gives you a nice exclusive audience with some of the recruiters, some of the partners and stuff. They are very supportive of those organizations. So I recommend you go ahead and come to that. Okay. All right. And I provided the registration information for that already. Okay, good. I just wanted to say that before I forgot, because if I say I'm going to do it at the end, then I'll forget to do it. Okay. So what we're doing here is flashcards of what is a flashcard. It's a one flashcard of what is required in a review. Okay. And so inquiry is required, and it's inquiry of appropriate individuals. Now, what do we mean by appropriate individuals? Well, the reason they're saying appropriate there is for what you should include on that flashcard is its internal inquiry. So there really is no requirement that we have external inquiry. Do we have external inquiry in an audit?
Yes.
Absolutely, right? I mean, we're doing confirmation as an external inquiry, for example, right? Yes. So we do in an audit, we do not have to have an inquiry of external individuals in a review. We have internal inquiries. Okay. Note put down here, no IC inquiry required. What is IC? Internal control. So again, they are giving us a pass on internal control work here, right? We will make inquiries about certain matters. It's of internal, not external individuals. Okay. Okay, good. Now that's the first thing that's on the not required flashcard. So let's just put a 1 there. Okay. The second thing that is that is required, we're in the required flashcard. Now we already did the not required, John. The second one is going to be analytical procedures. Okay. Now we know that analytical procedures are essentially what? Comparisons, aren't they? Okay. So what are we going to compare? We're going to compare the actual statements to budgets, financial to non-financial information. For example, the water bill at the laundry mat, right? Industry ratios, right? Disaggregated revenue data. Okay, I'm not asking you to flashcard this detail. Just know the nature of analytical procedure, which I think you know already because we've talked about these in other chapters, and that know that it's on the flashcard that you are required to do analytical procedures in a review. Okay, then we come over and we talk about review other procedures. Okay, and go ahead and include on your flashcard the third thing that we are required, which is other procedures. And guys, I think if you just put read stuff, that's good enough for this flashcard. Okay, they say, hey, should you read the reports of other auditors in a review? Yes. Should you read the financial statements for conform with GAAP? Sure, we do it in compilation. Why wouldn't we do it in a review? Okay, so very, very high level flashcard here, guys. What is required in a review? We are required to have inquiries, but the inquiries are internal rather than external and do not include internal control inquiry. We have to do some analytical procedures, which we know from our earlier chapters, or comparisons to the information of the financial statement where there's a plausible relationship, right? And then other procedures, just read stuff. Okay, all right, good. And then, oh, sorry guys, the fourth thing that is required, okay, I'm just redoing the outline here, is a client rep letter. Include that on the flashcard as something that's required. Now notice they go on a bit as to the nature of things that are required to be in the required representation letter. You don't need to flashcard all this because you already have a flashcard of what is required in an audit's rep letter. And it was what? Very obligatory things like management is responsible for the financial statements. They're responsible for the internal control. And then remember, I drew that line and I said the rest of the stuff is stuff that is hard to audit. Issues related to fraud, subsequent events, completeness of information. Remember that discussion? Same sort of thing that goes into the review management rep letter. Okay. Okay, good. So I'm not asking you for a big, long discussion flashcard, and then they show us the rep letter and they go on for pages and pages, you know, not pages and pages, but 3 pages worth of this stuff. And it's like, hey, Becker, you could save some paper by not, you know, printing all these letters that we don't look at. Okay. Now, what happens if you can't complete all the steps that you want to in an audit? What should you do in an audit? Not a review, in an audit. What should you do?
Disclaim an opinion.
Disclaim, or potentially, depending on the pervasiveness of the issue, go ahead.
Disclaim or qualify.
Disclaim or qualify. Even your dog knew, right? Okay, good. All right, so what happens here? Well, if you can't complete a review, can you qualify something? No, because I don't give an opinion. I'm not giving an opinion. I'm disclaiming an opinion. All I'm going to give is a negative assurance. Opinion is a positive assurance. I can't qualify my opinion because I'm not giving an opinion. I can't disclaim an opinion because I'm not giving an opinion. So if you can't complete the required review procedures that we talked about, you're not able to do the inquiries, you're not able to do the analytical procedures, or you're not able to get the management rep letter, you have no choice but what? Not issue a review report. And if we don't issue a review report, what are we doing? We are withdrawing from that engagement. If you don't issue the report, that's withdrawal. Okay, so if it's an incomplete review, you do what? You withdraw. So don't fall into the trap of a question that will say, oh, well, if you can't complete the review, you should issue a qualified review report. There's no such thing. When we qualify, we're qualifying an opinion. When we disclaim, we're disclaiming an opinion. And if you're not giving such, then you will have to withdraw. Okay. Okay, good. Now we come over and let's take a look at the documentation that we should have in a review. And do you feel a flashcard coming? I think every time we've had documentation summary in the book here, I've asked you to flashcard that. So we have the engagement letter. What were any findings? Was there misstatements that we asked them to correct, etc.? What did we inquire about? What were our analytical procedures? We're going to see in a second that we are going to have certain communications with management. Okay, communications with other accountants. Yes, we have to have a rep letter. And of course, we want to make sure that we have the copy of the statements we reviewed and our review report. Okay, now we are going to be required to have communication, and we're going to issue the review report. Notice the title of the report will say that we are independent. Flashcard that because we probably started to forget about our independent stuff, and it wasn't because it wasn't required for a preparation, wasn't required for compilation. It is required for a review. We address the report, and then we will have in there, and I just want you to flashcard the things that I've highlighted. Include a statement that a review is substantially less in scope than an audit. Notice, guys, we always have called out. I'm just trying to point to this yellow right here. We always call out that we are providing that we call out that higher level of service just to say that we're not doing it. And therefore, we're doing what? Are we disclaiming an opinion? Is that a disclaimer of opinion?
Yes.
So notice, guys, anytime you do a level of service that is less than an audit, you got to, when you issue a report, we don't issue a report for preparation. And if they don't put no assurance provided on every financial statement, then we have to disclaim that we're giving any assurance. But when we do issue a report, we always disclaim that we have audited, we disclaim an opinion on those financial statements. Okay. Now, continuing this flashcard, we will need to, this is all in one flashcard, what goes into the reporting for review. We will have to call out management's responsibility. We will have to call out the accountant's responsibility. Make sure you let the examiners know that they're in charge, okay, the AICPA standards, because they like to ask that question, okay, and state that the purpose is for us to do what? To determine if there are material modifications that should be made for the financial statements to be in accordance with the applicable framework. And then and they call it a conclusion paragraph. They can't call it an opinion paragraph because what? Because we're not giving an opinion, but it's kind of analogous to, it is analogous to the opinion paragraph, and that at the end we will say, we are not aware of material modifications that need to be made, nor for the financial statements to be in accordance with the applicable framework. In other words, we give what? We give that negative assurance. Okay, so make sure you flashcard, guys, these key elements of the requirement to communicate in the review report. Note, guys, this conclusionary paragraph just put down here is not an opinion. We don't give an opinion. It's a negative assurance. That says not an opinion. Okay. Okay, good. Let's go ahead and let's take a look at a couple questions. Oh, sorry, guys.
Put up the poll.
Yeah, sorry about that. I'm still a little rattled from the earthquake, no pun intended. So they're saying it was centered in San Leandro, which is, if you're not familiar with the East Bay, is just sort of north of Hayward. So that's probably why I felt it here. Doesn't seem to have extended much beyond Hayward south. And they're not showing any impact in San Francisco. Christian, I don't think you felt anything in Alaska, right?
No, but we have been getting quite a few earthquakes here as well. So I have empathy for you guys.
Oh, okay. There's a movie called The Birds by Alfred Hitchcock, and there's one part where they go, when the birds are attacking, and they go, and there's a drunk guy sitting there going, "It's the end of the world." So I don't want to be that guy. Okay, let's go ahead. Have you seen that movie? Let's go ahead and take a look at this one. And most of us got it right, okay? The answer here is A. And again, it's one of these things where they're asking us here, well, what is least likely to be done in a review? So it's sort of like our what not required flashcard, right? So observing safeguards over access to use of assets and records, that would be what? That would be in obtaining an understanding of the internal control part, which we are not required to do. We are required to do analytical procedures. So comparing is something that we would do. Inquiring, yes, we have to inquire. Studying the relationships, well, studying relationship is an analytical procedure, right? Okay, so the best way to attack that kind of thing is to make sure you have that required versus not required flashcard. Okay, good. Let's go ahead then and look at the next one. Okay, let's go ahead and take a look at this one. And okay, we got a pretty good outcome, at least 75% anyway, on this one. But let's take a look at it. Okay, and financial statements, and they talk about non-issuer here. Okay, and when we're talking about performing a review under the SARS, that's automatically a non-issuer. We're going to see that we will be doing reviews of public companies under the PCAOB requirements, and that's going to come in a few pages here when we start talking about interim reviews. Okay, so don't worry about non-issuer right now. I think you'll see it's clear. When they're going to call out issuer, it's going to be an interim review versus a full 12-month review, which is what we're doing here. And that's the extent of the assurance that we'll give for a 12-month set of financial statements. In this example would be, in this case, would be a review in the context of this question. Okay, so we're giving a review and they want to know what the report should say. And some of us chose A, provide limited assurance that the financial statements are fairly presented. No, it is a limited assurance, and the limited assurance is that what? I am not aware of material modifications that need to be made for the financial statements to be in accordance with applicable framework. I'm not sitting here saying the financial statements are fairly presented. The limited assurance I give that financial statements are fairly presented is the audit opinion, because it's limited to what? It's limited to reasonable assurance. So they're really telling you what you do in an audit report with that choice A. So when you look at this, guys, well, let me go through the rest of the choice. I'm going to make my little speech in a minute. Includes examining on a test basis information that is a representation of management that comes out of the audit opinion report that you memorize. You're testing on a limited, examining on a test basis information that's a representation of management. That's what you do in an audit. We don't do that in a review. In a review, we do what? Analytical procedure and inquiry. Okay. So is the review report, however, going to call out the higher level of service to say that we didn't do it? Yes, that's always the case. You call out the higher level of service. If you're doing a compilation, you call out the review, you call out the audit. If you're doing a review, you call out the audit. Does not contemplate obtaining cooperating evidential matter or apply certain other procedures ordinarily performed in an audit. Well, that's true, but we don't say that in the report. Okay. So you look at these questions, guys, and this is an important thing to keep in mind about the audit exam. Okay. It's not technically terribly difficult. I would say it's substantially less difficult than, say, financial, where you have all these horrible accounting standards and government and not-for-profit and this mile-wide stuff that you have to know for the FAR exam. What they do, though, what it does require is that you focus. You've got, and that's why I keep hitting on that. You've got to stay locked in, looking for the tricks, looking for the things that they're going to try to confuse you with. And you get there really by making the flashcards that I'm asking you to make, getting very solid with those flashcards, applying them to the problems, and the auditing exam should be a piece of cake for you. Okay? Okay, good. Now you come over to the next module, and I'm not entirely sure why they had to put us in another module, because usually modules like, okay, now something new has happened. Meanwhile, we've already started talking about the review report, and we're now just continuing that discussion. Okay, so let's just go ahead and let's take a look at some of the things that they tell us that we should do in the review report. By the way, the conclusion, I am not aware, there's the negative assurance, right? Now, what happens if we become aware? of a material modification needs to be made in order for the financial statements to be in accordance with the applicable framework. Well, guess what we do? We can add an emphasis. Well, strike that. I jumped too quickly. Reverse that. I didn't say that. I'm going to say that in a minute. I didn't want to say it right then. Okay. If there's something we want to emphasize, okay, at the auditor's discretion, we could add an emphasis of matter paragraph about something already disclosed in the financial statements. Okay. Now note that the emphasis of matter paragraph should include the heading emphasis of matter, and it would appear after the conclusion paragraph. So notice we're using a structure that's similar to what we learned back in chapter 1. After the opinion paragraph, if we want to, if we need to, we can add an emphasis of matter paragraph about something that's already included in the financial statements. Okay. If the review is in accordance with if the financial statements were prepared in accordance with another applicable framework, okay, such as the cash basis, then we have to include an emphasis of matter paragraph that indicates the financial statements are prepared in an other applicable framework other than GAAP. If we're preparing a regulatory contractual basis, then we will add that emphasis of matter paragraph. And here they did call out that we will restrict the report. That is typically the case if we're preparing or reviewing statements here in this case that is under a regulatory or contractual basis. Okay. Now, this is what I was trying to say before. If there are departures from the applicable framework, okay, what happens? If the financial statements are not revised, the accountant must consider whether to modify the report or withdraw from the engagement. Those are our choices. There's no qualification. There's no adverse opinion because we're not giving an opinion. Okay. So when the accountant believes there is a departure, it is appropriate that we will add a separate paragraph to the end of the report. So the paragraph will appear after the conclusion paragraph, the I'm not aware paragraph, and it will have the heading known departures. Okay, I'll have the heading known departures, and the conclusion paragraph will refer to that known departure paragraph. So you can see the way that looks there. You don't have to put that on the flashcard, but basically we'll write the review report. We'll say, other than what I'm going to tell you about in the known departure paragraph, I am not aware of material modification needs to be made in order for the financial statements to be in accordance with the applicable framework. And then is going to come a paragraph that has the heading known departure, and we'll call out whatever the departures are. Just be careful. That's not a qualification. We don't call that a qualification. We're simply calling out the known departures. Okay. If the report modification is not adequate, in other words, we're not able to fully describe the effect of this known departure, etc., then we have no choice but to do what? Withdraw. Okay. So again, guys, something that I've repeated it several times now. I know it's getting a little annoying that I've said it several times, but you are not going to be able to qualify adverse. If there's a problem, you call it out. And if your description of the problem is not sufficient to inform the user adequately, you have no choice but to do what? But to withdraw from that engagement. Okay. Okay, good. Now you come over and you do not have to, should perform review procedures related to going concern if the applicable framework requires that the entity disclose issues about going concern. Okay. And if you become aware of conditions that raise substantial doubt about the entity's ability to continue as a going concern. But when you look at that, you're basically saying, did they comply with the standards? And in terms of the management, the financial statements reporting going concern issues, It's different from what we do in an audit where we are required to do what? To look for the admits, finds, indicators of substantial doubt about the ability to continue as a going concern. And if we see it, then we're going to look for mitigating factors. If the mitigating factors alleviate the problem, we don't have to modify our report. If we believe that the mitigating factors or there are no mitigating factors will alleviate the problem, then we have to put in our audit opinion an emphasis of matter that says there's substantial doubt about the entity's ability to continue as a going concern, and we have to have those words in our report. Here, we're considering going concern because presumably the applicable framework required that the entity disclose issues about going concern. And since we have to review the statements to see if there's material modifications that are needed to comply with the applicable framework, then I guess we would have to do some going concern work, right? So let's just take a look. If after considering conditions and events that raise substantial doubt about the entity's ability to continue as a going concern, if it is alleviated, the account may but is not required to include an emphasis of matter paragraph. And if the going concern remains, the account should include an emphasis of matter paragraph that includes the term substantial doubt and going concern. What the heck? If after consulting conditions and events raise substantial doubt of the ability to continue as a going concern, management plans, the account concludes that going concern is alleviated, the account may but is not required to include the emphasis of matter. Going concern remains, the account should include an emphasis of matter that includes the terms. Okay, I stand corrected. We would have to put that in there. Okay, so I apologize for that. So we would need to put the word substantial doubt and going concern in an emphasis of matter paragraph. So I misspoke. We do need to do that. Okay. Question on that? I know I said the wrong thing there. Is there a question? Okay, good. Note that if the account determines the entity's disclosures are inadequate, then we would have to put something in the known departure paragraph that's saying, hey, they have a going concern issue and they didn't properly disclose it. Okay, so let me just take a look here, make sure I've got this all right. Auditors should perform review procedure related going concern if applicable financial reporting framework includes requirement for management to evaluate the entity's ability as a going concern, or if we become aware of conditions. Okay, so we don't have to do the admits find step to identify the going concern, but if it comes to our attention, or if the applicable framework says that they're supposed to do it, then we would want to do some inquiry and analytical procedures potentially to see if they actually did that. If it comes to our attention, okay, then we can go ahead and ask about the mitigating factors. And if the going concern is alleviated, we don't have to put an emphasis of matter. If we do have a going concern issue, then we put the emphasis of matter. If they don't disclose properly, then we put something in the known departures. Okay. Okay, good. Come over, and that's the end of the discussion of the review report. Now let's come over and talk about reporting on comparative statements. Okay, so what happens? Comparative statements are going to sit here, and we're going to have what? We're going to have, say, 2021, and we're going to put that in a column or format right next to 2020, right? That's comparative statements. Now, what happens if we have a situation in which 2020 was reviewed, but 2021 was only compiled? So did we have an upgrade in service or a downgrade in service, would you say?
Upgrade.
That's an upgrade, right? They went from what? From a compilation where there is no assurance at all to a review where not as good as an audit, but it is a negative assurance now, and it's a review. So what happens if that's the case, then we will have to put in our report as our last paragraph, we'll say, hey, by the way, here's the review report for 2021, and we did a funky compilation in 2020. So we'll just add a paragraph down there that'll tell them we simply compiled 2020. Okay. Now, where most of the questions tend to focus is what happens if we have a downgraded service. A downgraded service, right, is if what happened? If in 2021, I'm just going to put a C here, not 2012. If in 2021, we simply had a compilation, when in 2020, we had a higher level of service, we had a review. So if we have a downgrade in service, what we're going to do is issue a compilation report and add a paragraph to the report of the current period, and the other paragraph should describe the responsibility assumed for the prior period statements, which is going to say, hey, we actually provide a higher level, it won't say it was a higher level service, but it'll say we provided a review. And what I want you to put on the flashcard is in that compilation report for 2021, you must state, I'm trying to put flashcard here, you must state that no review services have been provided since the date of that previous report. That's what the examiners like to focus on, because they want to make sure that you know that you have to make sure that users know that you're not giving the negative assurance for 2021. That was last year, that was 2020. We have not provided the review procedure since then. Okay. Okay, good. Now, what happens if you have a current period prepared and prior period was compiled or reviewed? In that event, accountants have compiled or reviewed prior period statements, but prepared the current period statements. There's no reference to the prior period. And I'm going to ask you to flashcard that, but it's kind of like, well, where would I put that anyway? There's no report in a preparation. So I guess they're telling me you don't have to prepare a report at all if you prepare, say, 2021 when you compiled or reviewed an earlier year. Okay. Now they tell us here that you can't provide information in a column or format, information that you have not compiled, audited, or reviewed next to information that you have audited, compiled, or reviewed. It starts to get too difficult for the user of the financial statements to say, okay, this had some audit work done with it, this didn't. Because of that difficulty, they just sit there and say, you cannot put in column or format information next to each other that was not compiled, audited, or reviewed next to information that was. Also, you cannot provide in a column or format comparative information financial statements where there is missing disclosures for 1 year and you give the disclosures for another year. What they're saying to us in these last two flashcards I asked you to make is don't put such a burden on the user of the financial statements. They got to say, okay, this was audited. The disclosures pertain to this, but not to this. That gets too difficult. So they just tell you, step away from that. Don't do that. Okay, that's too difficult for the user to figure out what's going on. Okay. Notice that if there is a change in the report, and this should sound familiar to you, okay, if you change your report, it's not an opinion because you're not giving an opinion, but if you change some conclusions that you made in an earlier report, then you can add an other matters paragraph. You should give the date of your original report, a statement that prior periods have changed, the reason for the change in the original report. Okay, that's just like what we said for an audit. If you change your opinion, you have to provide these elements. Okay, if there is a predecessor accountant involved, and remember we had certain inquiries that we had to make of the predecessor. Okay, so what happens here? This is not the inquiries though. This is, I audited this year, you audited last year, and I ask you, is it okay if I present your report along with mine? Okay, so if the predecessor's report is presented, then the predecessor accountant will have to do certain things, and they will perform the following procedures, which you should flashcard. And you're going to read the statements of the current period, compare them to the prior period, and obtain a letter from me, the successor, in our little example, that I'm not aware of any problems with your previous report. It sounds very similar to what we said where we're trying to present the report of a predecessor in an audit. The key difference here is that for an audit, we also got a representation letter from management saying that they weren't aware of any changes that needed to be made in the predecessor's report. Here, we don't do that. We just get the letter from the successor. Okay, now remember, we said, hey, you don't have to present the predecessor's report. So here now, the predecessor's report is not presented. Okay, and remember, just like we said for an audit, if the predecessor's report is not presented, then the onus falls on the successor to essentially summarize the predecessor's report. So that's what we're going to do here. And you can flashcard the elements of what the successor will put in their report. And they'll say a statement that the other accountants compiled, reviewed the statements, the date of their report, a description of any modifications to the report. Remember, we said if there was a qualified, you'd have to say that there was a qualified when we're talking about this for the audit report, okay? And then that's the main things I wanted here. Okay, right here. If the predecessor accountant's report was reviewed in the prior year, then a paragraph should include a statement that based on his or her review, they're not aware of material modifications. Okay, flashcard those three main ones though right here. Don't worry about this last one. Okay, all right, good. And then again, report when one period is audited, current period audited, prior period unaudited. We have what? Again, we have the downgrade. Anytime you see a downgrade, you're going to do what? You're going to include that comment that no audit procedures have been conducted since the date of that previous report. Where is that? Right here. Okay. So I did it backwards. This is the downgrade right here. Prior period unaudited and prior period, current period unaudited, prior period audit, that's the downgrade, right? And when you do the downgrade, so it's right here, when you do the downgrade, you have to provide that comment. Okay, make sure you flashcard that. That downgrade here, they're talking about down from an audit. If it went down from a review to compilation, you make that same statement, although you wouldn't say auditing procedures, you say review procedures. Okay. Okay, good. Let's take a look at this question. Okay, good. Let's go ahead. Let's take a look at this one. Okay, make your best selection. And okay, most of us got it right. Now, the way to look at this question is you say, well, let's see, what am I required to do in a review? Okay, because they say what would cause you to withdraw. And you know that if you're withdrawing, that means you weren't able to complete something that you have to do in a review, right? So if the entity does not have a reasonable justification for making a change in accounting principle, what would you do in a review? Would you withdraw, or do you have another option? Well, is an entity supposed to have a reasonable justification for a change in accounting principle?
Yes.
Okay, so they're required to do so under general accepted accounting principles. So if a company didn't do that, what does that mean? That means they didn't follow general accepted accounting principles. So what should you do in a review?
Qualify it.
There is no opinion. There is no qualification in review. There's no such thing as a qualification in a review. There's no such thing as an adverse opinion in a review. You disclaim an opinion in a review simply because you're not giving an opinion. There is no qualify. What would you do? It's not withdraw.
You would disclaim, would you not?
You disclaim an opinion anyway. And you never issue a disclaimer for a departure from GAAP. Disclaimers come when you aren't able to complete a procedure. This is just, A is describing a departure from GAAP. What do you do if there's a departure from GAAP in a review? What do you do if you have a known departure, which is what this A is describing, from GAAP in a review?
It's included in the report.
Okay, where? It's a known departure. Where do you want to put it in the report?
I think it's in that known departure paragraph after the conclusion.
Exactly. Thank you. We have a paragraph for that, a known departure, and we would list it there, right? Okay, good. So A is not correct. You don't have to withdraw for that. B, the entity prepares the financial statements on the income tax basis of accounting. So you simply do what? You simply issue the review report, but you're going to have what? An emphasis of matter paragraph that's going to say they're using a different structure here, and you call out what it is and you say that it's not GAAP, right? You don't have to withdraw. You can review financial statements. Is that what we're doing here? Review. Okay. Engagement, you have to review. It's okay. You can review those statements. You just have to say they're not using GAAP in your report. C, the entity requests the accountant to report only on the balance sheet. There's no problem. That's a limited assurance engagement. You can do that in an audit. You can do that in a review. Again, my question, what are we required to do in a review? And we are required to do what? Analytical procedures. We're required to do what? We're required to make inquiry, and we are required to get a what? Get a management rep letter. And if they don't do that, that's a scope limitation. And if we have a scope limitation, there's no qualification, there's nothing to disclaim. We're disclaiming anyway, because we're not giving an opinion. So we have no choice at that point but to withdraw from the engagement because it's an incomplete review. Okay. Okay, good. Let's look at number 2. Okay, guys, let's go ahead and let's take a look at this one. Okay, most of us got it right here, 83% of us, but let's just take a second to look at this one, okay? And during an engagement to review the financial statements of a non-issuer, an accountant became aware that several leases that should be capitalized are not capitalized, so they didn't follow GAAP, right? The accountant considers these leases to be material to the financial statements. The accountant decides to modify the standard review report because management will not capitalize the leases. Under these circumstances, the accountant should. Can you issue an adverse opinion in a review?
No.
No, there's no such thing as an adverse opinion because you're in a review because you're not giving an opinion. Express no assurance of any kind on the entity's financial statements. No, because we have an option there, which is we can have that known departure paragraph, can't we? Okay. I don't know why my neighbor's dog sounds like he's in my backyard. Okay. C, emphasize that the financial statements are for limited use only. I don't even know what that means. That is such nonsense that it's ridiculous. I can't even explain that answer to you. D, disclose the departure from GAAP in a separate paragraph. Yeah, and we call that separate paragraph what?
No
Does
departures.
this matter?
No, known departures. Okay. When you have a known departure, you put it in a paragraph that has the heading known departure, and not capitalizing leases is a known departure. Okay, all right, good. Try number 3 here. this dog reminds me of it one time in, not this house, another house, my neighbor had a yapping dog, and the dog started yapping all night. And I was like, God, that dog is so loud tonight. And it yapped all night. Where are they going to take that dog in? It wouldn't shut up. So I get up the next morning and I still hear the dog yapping. And I'm like, man, it sounds like that dog's in my backyard. And I open my curtain and there's the dog in my backyard. Somehow he crawled through some hole in the fence. I was like, okay, no wonder he sounded like, so that dog sounds awfully close, but I think he's in the neighbor's yard. I don't think he got out. Okay, let's go ahead and let's take a look at this one now. And yeah, most of us got it right, okay? In that when we have a downgraded service, which is what we had here, right? They had audited a previous year and now they're only, shut up. And now they're doing what? Now they're only, what is it, reviewing now? Yeah, now they're only reviewing. Then when you have the downgrade in service, you need to say, and you call out that higher level service, no auditing procedures have been performed. There's no requirement that the CPA can include his name in the annual report. I mean, they do this all the time. In fact, you're required to say what, have the auditor's report in there, and the auditors will say, you know, whatever the company is, EY, whatever, Deloitte, PwC, KPMG. If I mention one, I have to mention the other three. And, you know, they even have to say how long they've been the auditors and stuff, right? So there's no requirement that you don't mention the auditors in the report. Okay. Question. Okay. So here's what's happening. We are not going to have time to get into module 6. So at least I am consistent, because I believe that last time I had the same situation where I wasn't able to get to module 6 in chapter 6. But I just want to confirm that I'm pretty sure that what I've already published here for chapter 6 picks up at module 6. Let's see.
Recording now so that somebody isn't able to do that the SBA
Okay. I'm thinking somewhere here. What is this? Yeah. I guess there's some other things that we were talking about, but once you get past this nonsense, yeah. So it starts here at module 6. Okay, so you will be able to watch that as part of the rest of chapter 6, which is contained in this lecture here. And then the final review lecture starts here, but I've posted it again under the final review module so that you can see it there as well. Oh, come on. Let me go back here, I guess. Okay, so it starts at 1:10:15, but it's the same file as this. So at some point I start the final review here, but you can also pick it up here. And then this is the rest of the final review. So you should be looking through all that. And then we are going to meet on this same channel, okay, the same link. We said 11 o'clock on Saturday, July. What day did we say? 11 o'clock Saturday, July.
I think the 3rd.
July 3rd, right? 11 o'clock.
I believe so, yeah.
Yep.
If I remember.
Yeah, and that's optional, guys. You don't have to come to that. I will make sure that they leave this page active, even though the class concludes tonight. They'll leave this page active so you can continue to access the information. If you have another situation where you can't make it to the thing, this question and answer session on Saturday, July 3rd at 11 o'clock, and we'll go 11, 12, 1, 2, 3 o'clock we'll be done. Is that 4 hours? Okay. Assuming we have 4 hours of discussion. If we end it sooner, we'll end it sooner. I'll record it and post it so it is there for you if you can't attend at that time. Come prepared with questions, guys. I'm not going to have prepared comments. I'll have the information available if you want to look at something, but it'll be more of a kind of like a open office hour type of thing more than anything. Question?
Just to confirm, we don't have to show up to class Wednesday for the first thing for BEC, right?
Correct. If you receive something from me that says, hey, welcome to BEC and blah, blah, just ignore that because I'll probably send some out to the whole class. But it's just like 3 or 4 people that are new that I'll have to hold that session for. Yeah, you don't have to come to that.
Okay, thank you.
Yeah. Question? Okay, guys. Thanks for all your hard work. I know I'm a little hard on you sometimes with this because I want to coach you up into passing this exam. So I appreciate your patience. I think you guys are in good shape. You should be planning to take this exam as soon as possible, doing your final steps here to get ready. I think you're going to be in good shape, okay? Would love to see you on Wednesday, not for our class, but for that Ascend meeting. I think you will see that it's a really well-organized, professionally supported organization that you can glean a lot of benefit from. Okay? All right, guys. Take care of yourselves, and we will see you in BEC, if not on Saturday at 10 o'clock. All right?
Thank you.
Bye-bye. Have a good night.